Morning, everybody. Thanks all very much for joining us. Welcome to our second episode of Back to School. We've got various people joining as we go, so we'll let them in as they come, but we're going to kick off on time. Today, we're focusing on how to prepare for transitions in these uncertain times, whether that be starting a family, slowing down, changing careers, moving home, retirement, etc. We see, across our range of clients that we look after, lots of different transitions that people go through, whether that's sports people who have relatively short careers early in their life and then move on to something else, or whether that's somebody that's been working in the same job for 40 years and then has to take the decision when to come to the end of that, and whether they've got sufficient income to be able to live the life they want to. And of course, one of the major transitions that people do have is retirement. And in a recent study done by Interactive Investor called the Great British Retirement Survey, it found that there were three main objectives for people who were retiring. One was peace of mind, two was not running out of money, and the third was having enough money to leave behind for children. Now, it probably won't surprise you to learn that the biggest regret of those people to come from that survey was not starting a pension sooner. But like all financial planning, striking the balance between our present and future selves is difficult. So to kick today's session off, we decided to start with our behavioral economist, who you may have heard from before, Mark Pittaccio. And he's going to talk about how you can prepare, not just financially, but also emotionally, for these transitions that you will face throughout your life, whether that's a change in career or retirement or starting a family. We're then going to come to the how you do that. So without further ado, over to you, Mark. Just need to unmute you so we can hear you. There you go. Should be able to hear you, Mark. Brilliant.
Okay. Good morning, everybody. Yes. Yes. Points you are well made, James. I often use the phrase that you make the decision to start a family, and then you sort of find yourself 10 years later running some kind of underfunded correctional facility. But we still like to call it a family. But the point you make is about the emotional side of financial planning. This is the bit that's quite often forgotten, but actually it's the part that makes the biggest difference to the choices that you're going to have when you make these transitions. I go to my financial advisor so they can help me with the technical side of it. So how are my assets held? Are they in the right name? Am I saving the tax? Am I in the right solutions? What can they give me that I can't potentially get elsewhere? But the key thing that they also do is they remove all the noise and they keep me invested. But actually, before you even get there, actually starting to invest and starting to save, we all know that pragmatically it's something that we should do, but actually we are not wired to do that. And I've made the point before that if we take ourselves back to when we were hunter-gatherers and we went out to make a kill to bring it back to the tribe so everybody could eat, the worst thing that could happen to us after we'd made that kill is if that we lost it to another predator. And as a result of that innate requirement to bring something back to the tribe, we massively overemphasize what is in front of us. So the worst thing that could happen is if we lost that kill to another predator. And so we have this natural loss aversion. So we value what's in front of us. And the research shows that if I ask people, do you want £100 now or £105 guaranteed in 1 month's time, nearly everyone would say, I want £100 now. But then if you ask somebody, do you want a 5% return on your investment in a month, which effectively is around 60% in a year, everyone would go, yes, of course I would. Well, effectively, you've just given that up because your requirement to concentrate on what's right in front of you is huge. So whilst we we all know that we should save. And whilst we actually sometimes feel that we're stupid if we don't start early enough, the good news is you're not starting not because you're stupid. You're not starting because you're wired not to. And it's something that you have to educate yourself to get over.
Brilliant. So do you think, Mark, should people, you said educate themselves, but is there any other things that they can do to try and overcome that, how we're wired as human beings?
Yeah, I think you try, if you can make a decision very early on and change your default setting, it really does help. So as soon as you are saving and that money is going away from your bank account and you're not seeing it, then you change your mental accounting. So we're very good at, we naturally mentally account. We put things into boxes. You may well have your holiday fund, you may well have a school fees fund, you may well, I like to ride bikes and I have my cycling fund, and we mentally account in all sorts of different ways, and it has quite dramatic effects on the way we see money and how we perceive it. The sooner that money you can get that money just leaving your account so you are not used to living on it, the better. And every month you are not doing that, you're effectively losing out because you're paying money unnecessarily to the taxman.
Transitions, Mark, we've done a lot of work together on musicians and sports people. You think there's a big similarity between them and people who are retiring later in life?
Yes, I think the transition thing that you talk about for various sectors and various people, it's just a matter of chronology, really. It's going to happen. With sports people, that we know it will happen sooner. So the key thing with sports people is, whilst you're absolutely dedicated to getting selected for the next match, and whilst your focus is very, very much short term, you know that at some point you're going to want to transition away from sport, and the idea that you're going to necessarily live for 30 years out of it, the money you've saved over that period of time, isn't really the objective. The objective is to have as many choices available to you at that point that you can possibly have. Now, when people are retiring as well, it's the same thing. So I do a lot of work on subjective well-being, and the fundamentals of happiness come from mastery. Are you good at the things that you are required to do every day? Autonomy. Do you have choice over your life? And relationships are extremely important. Being in a toxic personal relationship is more damaging to your health than actually smoking. So it has a really detrimental effect on us. So when you're going through these transitions, you need to look at where your mastery is, and also the choices that you've got. Sports people, for example, spend all their lives being masterful at what they're required to do on a Saturday afternoon, but actually they have limited autonomy because they're not selecting themselves to be in the team for the next Saturday. When you come to leave sport, or actually leave any job that you've trained for, quite often that mastery and autonomy swaps over. So you now have the world ahead of you again. You don't necessarily have mastery of the things that you want to do going forward, but you have a huge amount of autonomy. You can choose exactly what it is that you want to do. Now, creating a financial plan, the idea of it is it will then give you choices, so many more choices than you would otherwise have about what you want to do going forward. But people in their 50s and 60s now, James, they are finding that's a time of their life where they are mentoring people, where they are we have more entrepreneurs now in their 50s than any other decade. You've got more chance of doing more traveling. You've got more chance of mentoring people, more chance of learning musical instruments and different languages in your 50s and 60s than you have in your 20s and 30s, because the world has opened up again for you. So having choices, again, not only if you're a sportsman retiring in your 30s, but actually if you've had a normal career, time-wise I'm talking about, and you're coming towards the end of that in your 50s and 60s. The idea that you're going to just jump off a financial cliff hoping you've got enough money to gently glide you down into your grave, it's certainly not a conversation I want to have with my advisor. It's really a conversation about, okay, what does my retirement look like now? And rather than being I'm going from binging on work to binging on leisure, it's a transition where there's a lot of things in my working life that I've really enjoyed and that I may want to continue with in some way, shape or form. So it's having those choices that's key to having a financial plan.
And how important is it for people to prepare for that? I mean, I know a bit of a morbid study, but a good one is for the big four accountancy firms, the average life expectancy of a retired partner is 8 years.
Yes.
Which, just shows that actually, you spend your whole life working to retire, but then actually, in some cases, especially people that have worked really hard and had high levels of stress, stopping can result in physical problems as well as emotional and financial. So, how important is it for those people to plan out what they're going to be doing with their time rather than, as you say, just falling off a cliff?
Well, it's absolutely vital. People who successfully retire to something, not from something. And that's a key differential. Now, most people, most of your clients, they are involved in jobs that have an element of things that they really like to do. So taking that forward in some way, shape or form is important. But what we found is that successful retirees are the ones that had a plan for their retirement. They very much wanted to retire to something. They had an idea and a plan for what that was. People who have failed at retiring, they use the phrase, well, I went from who's who to who's he overnight, or my retirement failed at the 19th hole. I realized that I just had no purpose in playing golf every day. It really wasn't giving me that sense of mastery and autonomy and that sense of purpose that I wanted going forward. If you've created financial assets to enable you to have choices, that's the key thing, because then you have so much choice about what you can do and what you can control, as opposed to having to do things that maybe you don't necessarily want to.
And how's the pandemic affected that, Mark, if at all, for people that we're talking to and you're talking to?
Well, globally, it's interesting because globally, the pandemic is affecting different cultures in different ways. That's been some very interesting research that's come out of the university that I'm associated with. But the pandemic, it's about purpose, actually, James. If I think about it. In the same way as you want to retire with purpose, actually coming out of the pandemic, coming out of lockdown with some form of purpose, I think is really important. For a lot of people, there have been things that they've actually enjoyed, in a sense, about the pandemic. That sense of communities coming together, that sense of family. A lot of people I know have changed their diets, they've changed certain habits, they've maybe got fitter and things like that. And so what we're saying to people is actually take time to consider the things in the pandemic that you have felt have been beneficial for you and carry them forward, because otherwise I can see ourselves in sort of 4 to 5 months' time experiencing a thing that we like to call lockstalgia, where we look back and go, well, actually there were things about it that really were beneficial. Why didn't we carry them on? As I say, we're all in the same storm, but we're in very different boats. And I think, some people have been furloughed, some people haven't. Some businesses like Netflix and Amazon have been incredibly successful. Others have really, really struggled. A lot of small businesses have really struggled. So it's about coming out of it with a sense of purpose. And obviously, again, we come back to financial planning. Has been an integral part of the way a lot of people have planned for the pandemic as well. So having your financial plan in place and having the flexibility to be able to deal with the different situations that you're going to face in your life is really important. So the key thing is get a plan going, get it started, and start funding it as early as you possibly can.
I was just going to say, before we sort of move on to the how under the bonnet of how you actually do that, what would be your top 3 tips to people listening today, to actually action things? I mean, we're all guilty of it. I need to do this, and you put it off today, you put it off tomorrow, put it off, and I think lots of people get stuck in that cycle of I'll come to this next year, or I'll come to this when I've got that new job, or I'll come to this when I get my bonus.
Yeah.
How do people overcome these quite natural thought processes that we all have?
Inertia, yes. It's so the way to look at it is not actually when you start it. It's what are you losing out on by delaying. That's the way to look at it. If somebody said to you, right, every day you don't make that phone call to David James Wealth, for example, you are going to be giving away, shall we say, £200 to the tax man unnecessarily. People would pick the phone up. Yeah. So it's changing that mental default setting to really saying it's not what I'm gaining at some point in the future. It's what I'm losing out on by not acting now.
Yeah, that's and sorry. Last point I find really interesting, and coming from this as I did from a sport background. Do you think the jargon around our industry makes people bury their head in the sand because it's just too different? Where do you start?
Yeah, I mean, it's a lot of it's a total nonsense. I mean, as far as I don't mean to decry the technical knowledge that people like Rick and David have. Is absolutely vital. Like I said last time, I trust these people to make sure that I'm invested and I'm put on an investment journey that they understand I'm prepared to take. And I'm interested in the technical detail to a certain point. The biggest advantage for me is not in getting my assets held in the right place, making sure that they're in the right names, that my trusts are in place, that the children are all right, that the will is created, that the investments are appropriate for our needs. The key thing is they remove all the noise that I hear on the news, all the noise that is just there for a day and actually has very, very little relevance to why I've invested in the first place. And to have somebody like David who says, look, Mark, volatility is part of the world. Let's remind ourselves of why you've invested in the first place. You've invested this money because you want your daughter to go to university in 11 years' time. So what Robert Peston has said last night on the 10 o'clock news has got absolutely no relevance at all to whether that's going to happen or not. So he constantly reminds me that volatility is something that we all need to accept. Most of it is completely irrelevant. Let's remind yourself, Mark, of why you invested in the first place. And let's look at things over that time frame, not just what happened yesterday. So it's the behavioral coaching that is really, really key. And the studies have shown that staying invested is absolutely the key thing. I mean, as anybody who cashed in, I think David will probably know the detail, but when the pandemic first hit, if you'd crystallized your losses back then, or in 2008, you can imagine crystallizing your losses in 2008 and missing on the recovery. So they remove all that noise away from me. I often think, but people like David should be allowed to take our money and blindfold us for 10 years and then just show us what it's worth 10 years later, and take away all the worry on the journey, which is obviously what they do. Brilliant.
That's fantastic. Thanks, Mark. I'm sure we'll come back to you shortly, but I think if we now move on to a bit of the how, really lucky to have Rick Ealing with us today, who's investment director at Quilter. But we're going to start with David, who's just going to touch a little bit on the how and then bring Rick in to go even further under the bonnet. David, over to you.
Thanks, James. And yes, thanks for that image, Mark. I guess it would make my job a lot easier if I could blindfold you for for 10 years and just get on with it. But funnily enough, the regulator wouldn't be very happy with that, and I don't think I would either. But there we go. But I think you make a very good point. It is about looking at the purpose of these things. It's very easy for us, as you say, whether it's Robert Pesson or whoever. We are bombarded by information in the news, in the press, and all sorts of stuff around us when investment markets are doing really well or investment markets are doing really, really badly. And because of our own instincts, that does drive us to want to get on that sort of bandwagon when we see things rocketing away, whether it be, Apple or Zoom or whatever that's been doing really well, and then panicking when they start falling, rather than actually looking about what it is that we're trying to achieve. And this is why we always talk about financial planning with purpose. What is the point of this? Why are you putting this money away? What are you actually trying to achieve? Because it's only by understanding what it is that you're trying to achieve and the timescale that you have to achieve it that you can start to build a plan. And it's only then that you know the sort of things you can and can't do, the things that you should do and the things that you shouldn't do. So, for example, anyone who was talking to me in March, April, after the significant falls of the stock market saying, is this a great time to be investing money? Well, the answer is, it depends. What are you investing it for? If you're trying to make a fast buck, but you need to be able to spend that money in 6 months' time, well, the answer is no, this is not a good time to be investing, because if the market falls again 2 weeks before you need to spend the money, that's not going to work for you. If, on the other hand, you are investing for something that you're going to need in 10, 15, 20 years' time, actually, the fact the market has just fallen by 25, 30% is irrelevant in the grand scheme of things. It's about understanding what you're trying to achieve, what risks are therefore really important. And this is the key thing. Understand the things you can control and the things you can't control. Everyone out there, too many people are trying to chase the returns. We get excited by returns and panicked by the falls, but you can't control those by definition. So don't try and control them. Understand the things that you can control. Sorry,
David. What you said there is spot on. And I think just to for those listening, if you don't believe that, we've got recordings of these seminars we did back when the pandemic first hit, and that it was exactly what David was saying. So I think for those that want to listen retrospectively, it's quite a good thing to do. Can you explain a little bit, David, about that let's say somebody has overcome these barriers that Mark and I were talking about. They've decided, right, we're going to put a plan in place for whatever that is. How do you then go about doing it? What's the sort of, what does it look like in layman's terms for people? How do we come, and whittle down all the various solutions and options that are out there in the universe to, right, this is the plan for you. And just before I let you answer that, everybody, please, if you do have questions, write them in the chat box as we're going, and we'll ask them as soon as we can. So feel free. This is meant to be interactive, so if you've got questions, please do fire them in the chat box. Sorry, David, over to you.
No problem. Yeah, it's about understanding, as I say, the level of risk that you need to take and what are important risks. And people focus on investment risk, but you've also got to take into account inflation risk. We need things to keep your assets to keep their value in real terms. So money that you're going to be spending in, say, a year's time, maybe even a couple of years' time, depending on how cautious you are, you need to leave it in cash. Because you haven't, if something goes wrong, you haven't got the time to wait until it sorts itself out. Because the thing that we know is that things in investment markets, in real assets, whether it's stock markets or gold or property or whatever, it will go up, it will go down. We just don't know when. So money that you're spending, if your timescale is a couple of months, a couple of years even, that needs to go into cash. Money that you're spending, that you need to spend in, say, 5 years' time, 10 years' time, or beyond, if you leave it sitting in cash, you are going to lose money. Because even though today's inflation rate is 0.2%, and there probably are a few people out there who are getting slightly more interest than that, the longer term interest rate is more like about sort of around the 2 to 3% mark. So, and there are no cash accounts that are paying anywhere near that. So if you leave your money sitting in cash for the long term, you will lose money. So this is what we do, is we put together the right combination of what we would call real assets, shares, property, cash, bonds, all these other bits and pieces, the technical words that Mark was talking about, to get the right portfolio that gives you the best probability of achieving what you need to achieve over the timescale. Okay. And it helps us sort of work out that plan that I'm talking about, that financial planning with purpose. Where do you need to get to? How long have you got to get there? And therefore, in an ideal world, how much return do you need to get you from A to B? And we can
and you map returns between a certain parameter. Is that it?
Yeah, so I mean, if you said, okay, this is where I'm starting, this is what I want to achieve, and I know I've got 10, 15 years, whatever it is to do, it's very easy to do the math and say, okay, to get the pot of money from A to B over that time scale, it needs to grow by this amount on average every year. Okay, and what we can then do is say, to achieve that, what level of investment risk do we need to take? What sort of proportion do you need to have in global equities? How much proportion do you need to have in property and all these other bits and pieces? And then we can have a conversation about, is that level of risk something with which you as an individual are comfortable?
Yeah.
And if the answer is yes, fine. We know that that plan has a good probability of working. Okay, the journey will have a lot of unexpected events, as these things always do, but we can be pretty confident that over that period of time, as long as we stick to the plan and keep reviewing it on a regular basis, you will have a chance of achieving that. And a key point, of course, is remembering is if it's retirement or these transitions that we talk about, that timescale is part of those transitions. These timescales would change. So, someone who is in their 30s planning for retirement in their 50s or 60s, they can take a lot of investment risk because that's the time horizon that Mark was talking about. It's a long term. It doesn't matter what it's worth tomorrow. It matters what it's worth in 15, 20 years' time. But in 15 and 20 years' time, that time horizon is a lot shorter. And so the sort of things we're doing need to change, because at that point, you don't want to have the problem of what happens if the stock market falls by 30% tomorrow, which is the day I'm retiring. Okay.
And David, our industry's changed, dramatically, I would say, over the last, well, even 10 years. You've been doing this for 25 years, so you've been through number of changes with your clients. Why us now? For clients thinking about engaging with someone, why should they engage with you? How are we set up that enables us to do the job that we do?
Well, I think a really key part of what we do is knowing that we have the right tools at our disposal. I touched on earlier about understanding things that you can control and the things that you can't control. And for me, one of the most important things is that when I'm putting together an investment portfolio for a client to achieve the particular objectives, is that I can be confident that I understand the level of risk that's going to be within that portfolio. Now, I have operated in all sorts of different regulatory fashions from when I first started as a single-tied advisor right through to independent and everything in between. And one of the things that I know for sure is that as an individual, if I was taking on the full responsibility for doing all the research and trying to understand what's under the bonnet with all these investment funds that are out there, I mean, there are 50, 60,000 options for investment for clients, for retail clients. And looking at all of those, I as an individual cannot possibly do the level of due diligence that is necessary for me to have the absolute confidence that I understand what's going on under the bonnet. Because it's not just a one-off thing, it's something that's got to be done, day by day by day. And even the decisions that you make, you then got to come back and review that. And I do not believe that an individual, even with all the research tools and things at my disposal, which I have and I use, I cannot do that. And therefore, one of the reasons, and Rick will go into more detail about how they do this, that we decided to partner with the Quilter Network was that power of research that they can do. It's not just relying on me. It's the quality of research that they do out there and the independent entities that they have that produce that. So I can have confidence not only that what is there in front of me as saying these are good options for you to choose from, are going to do what they're going to do now. They're going to do what it says on the tin. But in 3 months' time, in 6 months' time, in 3 years' time, in 5 years' time, in 10 years' time, if that's changed, I get to know about it.
Perfect. So I think it's a great time to bring Rick in. Rick Ealing is the investment director at Quilter, who David touched on there. We plug into Quilter Financial Planning, whom some of you may have heard of. A very, very big company, FTSE listed company. They do a lot for us. I think to start with, Rick, it'd be really helpful just to know what you do.
Sure. Well, good morning, everybody. As investment director of Quilter's advice business, my role is to make sure that all the investment solutions we take to market are aligned with our investment philosophy, which is very close to what David's just been talking about. It's that idea of risk-based, goal-based, long-term financial planning. We operate a series of properties which between them power about 15 to 20% of the UK advisory market. As James said, we're a listed company, £3 billion market capitalisation. We're the second largest wealth management group in the UK, and in my opinion, the best. We want to be the largest, but we want to get there in the right way, and the right way is by making sure that there are no nasty surprises and that we don't disappoint our customers or indeed the firms like David James that we partner with. We operate in two ways in the advice space. We have a network model, which is where independently owned firms like David James choose to partner with us for services. And we also have a national model where we employ our own financial advisors. The network model is much bigger. I've got to say, David and James are a joy to work with because philosophically they are very aligned to where I am. I've always been a believer in goal-based financial planning. In other words, don't just invest because you think you should. Invest because there is something you want to achieve, and understand what that is. And I like to break financial advisors down into three categories. The first two aren't very good, and the third type are the type that I like to work with. So the first type, you've got scamsters. Sadly, for many years and still, our industry does occasionally bump up against crime and fraud. There are people out there who bring things to market that are quite dishonest, that are misrepresented, and you will just lose all your money. If you want to take one thing away, if you ever see anything represented as high reward, no risk, it's a scam. You don't need to know anything else about it. If they pitch it in those terms, it's a scam. There aren't that many of them out there, but sadly they do exist, and we always like to make sure that our clients and our advisors are able to identify these things. So scamsters.
That's like someone offering an 8% guaranteed return, something like that.
There is no such thing as an 8% guaranteed return. If you want a real return, that is to say a return over and above inflation, you must take investment risk. And just as other people have said on this call, the way to do that is to be informed about how much risk you're taking, what that means in good markets, in bad markets, and in average markets, and then to settle in for that journey. So yeah, stay away from the scamsters. Then you've got tipsters. Now, tipsters are honest. They're not going to rob you, but they think they know a lot more than they really do. And these are the advisors who will say, I know that this fund's a good bet, so here's a good place to be, and I'll be back in 12 months and I'll recommend some more funds. And I'll be back in 12 months after that, and I'll recommend some more funds. And by the way, the US is going to fall by 15% at 2 on the 27th of May. These people don't know what they're talking about. Uncertainty is fundamental to investment, and the best advisors are the ones who admit what they don't know and control what they can control. So the tipster model is one that we don't like to work with. We like to work with the third type, the best type, and that is planners, goal-based financial planners who understand in great detail what their customers want to achieve, their circumstances, their psychological approach to risk, their capacity for loss, their understanding of investments, and then define specific objectives with times and numeric objectives potentially, if it can be formulated in those terms, and then they assign an investment portfolio to meet those objectives. And key to this is the fact that financial planning and investment management are very close cousins, but they are different skills. Being a qualified financial planner doesn't qualify you to be a fund manager, and vice versa. But linked to that, of those two disciplines, financial planning and investment management, the most important of the two is financial planning. You're always better off with a good financial planner and a so-so fund manager than the other way around. And that's because it's the financial planner that will manage and prevent some of the stuff that Mark was talking about in his opening presentation, the behavioral errors. We, all of us, whether we're experienced investors or first-time investors, we all have that emotional desire to cut and run in a market fall, or to get greedy and chase returns in a market rally, or to fiddle with our plans, to check our valuations too often, to make plans and then turn back on them in 3 months' time. All of this stuff affects all investors. And it's the financial planner standing by you over the life of the journey that can prevent those errors. And we've seen that enormously this year because, as you know, the markets fell quite dramatically up to March 23rd and then have gone through a very rapid recovery. Most of what we have on our matrix, and I'll explain the matrix in a moment, most of what we have on there has recovered everything it lost in the downturn and then some. But unfortunately,
Rick,
in March,
could you just really interesting, sorry to cut in, but really interesting story you told when we last spoke about an example of somebody that did make a change during the fall, switched to a fund that had done well in the fall, and then of course, anyway, you'll explain it better than I have there.
I was just coming on to that. So
I mean,
all investment funds, they all have a style. All fund managers have styles, and different styles are flattered or not flattered in different market conditions. And sometimes what it's tempting to do is look at short-term performance, notice that in that period one fund has done better than another, and therefore conclude that the right thing to do today is move from the worst performing fund to the better performing fund. On the face of it, that sounds like it makes sense, but unfortunately it doesn't. Because what we saw during the downturn is that funds that did relatively better on the way down have done relatively worse on the way back. And funds that took more downside up to March 23rd have all come roaring out of the blocks and done brilliantly on the way back. So if you're in either of those funds and you just relaxed and sat there and let the fund style play through, you've done okay. If unfortunately you tried to make the jump, then you've just taken the downside and then lost out in the recovery. And so this idea of stick to an investment, as long as it's the right type of investment, constructed in the right way, with the right risk profile, stick to it. And that's hard. Very easy thing for me to say, but it's very, very difficult not to believe that we can improve our outcome by fiddling. Fiddling is not good. Make a plan, stick to it.
Perfect. And how do you whittle down? David mentioned 50, 60,000 options out there. How do you bring that down into a group of investment styles and investment objectives?
Well, we offer a pre-selected range of investments called the Matrix. There are 65 things on there, and they all have some simple but important things in common. They're all multi-asset portfolios. So inside any one of our matrix solutions, you'll find a blend of equities, bonds, cash, and other assets, and you'll find those assets from around the world. In other words, these are all finished, ready-made, off-the-shelf portfolios. They're complete and entire in themselves. You don't need to add anything to them or take anything away from them. They're all risk-based in the sense that they're either designed to deliver certain levels of risk, or we've been able to do our research on them and take a view that their risk is going to be at a certain level over the long term. That's almost the most important aspect of fund analysis for me, is being confident in the risk level a portfolio will deliver. They're all managed in the sense that there is an investment professional in charge of each one of them. And that person's doing the underlying selection of regions, of asset classes, and of different instruments. And they all have clear styles. Some of them are fully active in the sense that they're, let's call them full fat unrestricted. They can go anywhere, do anything, buy anything. And at the other extreme, some of them are fully passive. They only buy in index trackers as their underlying assets, and everything in between. These 65 solutions, they come to the matrix in two ways. Either we build them and design them ourselves, and that's about half of them. We have an investment management firm inside Quilter Investors, very experienced multi-asset teams, and we can say to them, we have a customer need for say a balanced investment with this style. Can you build us one? And they do. The second way we bring things to the matrix is by selection. And we select things independently with a small I from the whole market based on what I think is the most robust fund selection process currently in the UK. We are the only firm I know of who employ 2 fund analysis consultants, Morningstar and Square Mile, on bespoke analysis contracts. And not only that, we make them cross-check and challenge each other's work. So third-party funds, that's to say from outside Quilter, can only make it onto the matrix if they're selected by Morningstar and then approved by Square Mile, or vice versa. It's very, very rigorous.
And how often does it change, Rick? How often do funds come off or go on? Yeah, I suppose a client. We had a client during lockdown said, "Well, nothing's going on. We're not making any changes. What are you actually doing?" Yeah, I think that sometimes people look at it and go, "Hold on a minute, nothing's happening." The reality is there's a lot going on under the bonnet, but from the outside looking in, it might look like you're not making changes or we're not doing any work.
Yeah, well, we don't make a lot of changes, and that's a sign that we're getting this broadly right, because we only pick a fund for the matrix if, in our view, it's going to be right for the long term, for a defined level of risk and a defined customer objective. It's not a best buy list. You'll often open the paper and there'll be a sort of top 10 recommended fund list, and that changes all the time. Lists like that, in the nicest possible way, are essentially useless because they're all based on past performance. Yeah. We don't base our selections on past performance. So we're not just, say, looking at what's the best fund in this industry sector over the last 5 years and then blindly sticking that on the matrix. What we're doing is a much deeper analysis of what this thing is, what it holds, what its style is, what its risk level is, and what its future prospects are. But having said that, we do take funds on and off from time to time. We took 2 off in August, and in both cases we took them off because we no longer considered them likely to deliver a customer objective at the box they were in. When funds go through weak periods of performance, all funds do that over time, that may not be the right time to take them off, because it can mean that the stuff you've got is undervalued. And if it's undervalued, why are you taking the chance to sell it?
Yeah,
that's a sort of a logic that we often apply.
Speaking of value, I heard a really interesting stat the other day from you, actually, regarding trackers. Passive investments are quite buzz at the moment. People are, not necessarily rushing towards them, but there's certainly a lot more noise around passive investment than there used to be, and for good reason. But you mentioned about if you're buying into a passive that's, say, tracking the US market, predominantly you're in 5 companies.
Yeah, I mean, so it's true that over the last 5 years, passive investment has generally, with some exceptions, done better than active. The key thing to ask ourselves is why that is, and whether we think the trend that caused that is sustainable. And the key trend that's driven that, certainly in the US market, is what we call FANG stocks. So there's Facebook, Amazon, Apple, Netflix, Google, and Microsoft gets included with that group as well. 10 years ago, those stocks collectively made up about 4% of the S&P 500. Now, they've gone through enormous growth, and we're all probably partially to blame for that. I've used Netflix a lot more since March. I've bought a lot more on Amazon since March. I've bought myself a new Apple MacBook a few months ago as well. So these are massive companies, but arguably they're now too much of the S&P 500, because today, collectively, they're not 4% of that index, they're 22, 23% of that index. And their current share prices imply double-digit growth over the next 10 years. So, in other words, the share price of Amazon is only correct at today's level if the firm is going to grow at, I think, 19% a year for the next 10 years. We have to ask ourselves whether we think that's likely or not. Typical growth for an S&P 500 stock is 5.2. So when something does better than something else, the sort of temptation is to go and buy that thing. You've got to remember, you can't have the past, you're going to get the future. So understand the trends that gave rise to the historic performance and ask how likely they are to be repeated.
And that, Rick, that's not to say we don't use passives or passive investing. I think
No, not
it's
at all. Yeah.
it's a big part of what you and we do. But I think it's just a really interesting point that you make there, that people perhaps don't realise when they're reading the Sunday Times or the FT or something, and it's talking about how well passive investments are doing.
Yeah, absolutely. Look, there's a right and wrong reason to use passive, and we do have many passive solutions on our matrix. The right reason is because you philosophically reject the whole idea of active management. You don't believe that it's possible for active investors to add value over the long term. And if that's your view, that is absolutely fine. We have investment solutions that can back that view. The other reason to do it is if cost is your central driver. You almost don't care about anything else except how cheap your portfolio is, and you're willing to accept that will mean there are opportunities you can't access, there are asset classes you can't access, and there are limitations on what your portfolio can do for you. If cost is your priority and/or you reject active management, by all means go passive. But don't go passive because it's outperformed active over the last 5 years, because as I said, that may not be the case in future.
Very good. We got a question to David in the chat box, and I think actually we'll ask David first, and then Mark is probably quite well placed to answer this as well. Are there minimum investment required before we deal with clients, David?
No, is the simple answer to that. It's our perspective is can we actually make a difference? Can we add value to an individual or family or company, whatever it is? And so it doesn't really matter to me what the size of the investment is. It's a question of, is there something that we can do that is going to make it worthwhile for that individual to engage with us?
Great. Mark, should people think I've not got enough to start?
Oh no, whatever you've got, it's a balance, isn't it? It's dealing with that desire to spend all the money that's in front of you on beer, sweets, and cars, but know that really, create your new default and get some of it put away, and you'll still be able to afford the beer, sweets, and cars, even though you've invested. You'll just manage yourself in a slightly different way. So. Get it started with whatever you can afford to put away.
Yeah, and I think that's a common theme actually in our industry. Look, do you understand that from a behavioural point of view, that people don't engage with an advisor because they think they're not wealthy enough?
I think that's very true. But the good thing is that advisory businesses now, they're creating propositions to help all generations of families. And I like it when I see sometimes businesses like yours could be looking after 3 generations of the same family. There is I think you can now invest, can't you, for a pension for your child as soon as they're born. And there are some astonishing statistics that if you invest for them the day they're born, by the time they're 18, if you just leave that invested, they may not need to invest themselves. So that's how much of an impact early investing has. But I think Rick makes a very in a technical way, makes a very valid point. People can't have the past. And we all think, because something has done so well, we should get involved in it. I think it was, and this is how bubbles are created, because everybody jumps on board. I think there's this famous case of tulip bulbs in the 1600s. It was absolute mania because tulip bulbs were rare. Everybody wanted to invest, and the cost of them rocketed to sometimes the 6 times the average person's salary. Well, we all know that the tulip bulb has no underlying fiscal value whatsoever. But we've seen in 90, the
Bitcoin.
stock market. Yeah, Bitcoin. Well, even the stock market crash in the 20s was actually a tech crash because it was based on radio stocks. You've seen Bitcoin now, so it's somebody, a firm like yours will take the noise away and go, well, what is it really worth? How's it really going to help you? This is just gambling. It's not investing. It's not having a financial plan. And like I said, your ability to take the noise away and help me to understand what is relevant to what I'm trying to achieve is the key reason that I use businesses like yours.
Brilliant. I think 2 final points we can't really leave without touching on these. So Mark and Rick, if you could, US election coming up in November. How's that going to impact markets and behavior? Rick first, please.
Okay. I mean, it's difficult to talk about this without sounding melodramatic. But if I look at the climate over there right now, I am genuinely concerned about the risk of civil unrest in November. Because you've got a heavily armed population. You've got a president who has effectively endorsed people like Kyle Rittenhouse, the teenager who shot some Antifa protesters. That there's a suggestion coming out of Trump that if he loses, it's because the election was rigged, and that really worries me. Now, the US has been held up as this beacon of global political stability throughout most of the 20th century. How on earth do we respond to serious civil unrest over there? I don't know. And there's a wider theme at play here, which is that shift in the sort of global leadership away from the US and towards other countries like China. And obviously the trade war that's been going on between the US and China for some years now always affects markets whenever it escalates. So that's one to worry about. Having said that, a lot of stuff that happens in the real world, just like the COVID pandemic, doesn't necessarily impact markets, because markets exist in the abstract. They exist in the financial world, and there can quite often be a disconnect between what the market does and what's happening on the ground. We've seen that many times. It isn't always the case that declining economic activity equals a declining stock market. It can be the other way around. So I'm worried about the US in terms of I wouldn't like to be on the streets in Portland on November the 3rd if Trump's lost by this much. But I think the markets will ride it out.
Great. And marked it from, again, something to worry about that might stop people doing things.
Well, I think if you're asking me from a financial perspective, I'd have to say it's another event, and it's irrelevant in terms of why I'm investing. I have views about it as a human being, and I have views about it politically, because obviously we connected with politics as well, studies in politics and economics. But as far as financial planning is concerned, there's always a reason not to do something, James. There's always something about to happen that might have an effect. And all these things dilute over a period of time. And it comes back to David's point. What is the purpose behind your investing? And if you've got a purpose, then all the rest is just noise.
Yeah. Last point, coronavirus. Speaking to a lot of big companies, Rick, and managers of enormous funds, how do you see that playing out? Is there going to be a magic bullet? Is it going to be we get used to living with this? We're going to go into another lockdown? What do you see happening? Impossible question to answer, but please give it your best go.
Yeah, I mean, so it is impossible to answer because it's an unknown, but to give a meaningful response to the question, most of the portfolios on the matrix stuck to what they have throughout March and throughout the recovery. There's this popular perception that what investment management is this form of very high octane, rapid gambling. That looks good, jump in. Now it doesn't look good anymore, jump out. What about this? What about that? What does it say in the news today? Good heavens, we've got a pandemic right now, let's do this. It just doesn't work that way. All of the funds that I work with on the matrix, these are managers who look at underlying companies. They take long-term views on cash flows and prospects. They diversify so that if one does well, another might do less well, and they'll offset each other. They're not sort of betting on whether there's a second wave or whether there's a vaccine or whether there's any of this stuff. They're looking beyond all of that and just going down to company fundamentals and then sitting on what they have. Investment management portrayed in media is this really exciting thing. In the real world, it's extremely dull and very slow, and a lot more like gardening than gambling.
Fantastic. Some great phrases this morning. Much more like gardening than gambling. I'll write that one down. Mark, you have said that we've got challenging times ahead when the furlough scheme ends. Could we just end there?
Yes, we have, but and Rick hasn't seen the state of my garden, so what I would say is like I said, when we look at the potential, if you want to look at the political impact, because I said the financial impact, I think of this, of course, it's very relevant, but in terms of financial planning, it will just, the effects of all these things do dilute over time. I think what we will find in terms of financial planning and in terms of our lives, I'm of a generation where really the intervention of the state has been rolled back throughout my lifetime. And I think now when we see that we're living in a first world Western country that is effectively paying the salaries of 11 million people, I think that certainly from my perspective, what I now not only expect the state to do, but also understand their ability to do has changed. So I think going forward, there's going to be probably a lot more state intervention in our lives, and that will bring about all sorts of financial opportunities and potential requirements to again have a good financial planner to make sense of sort of probably a new range of incentives to encourage people to save and make sure that they're secure in their long-term futures.
Great, brilliant. Mark, Rick, thank you very much for joining us. We really appreciate your time. Everybody, I hope you found that useful. Thanks to you too, David. Take care, everybody. Stay in touch, and if you have any questions following on from this, please just let us know. Thanks very much. Bye-bye.